Not knowing how to properly utilize the tax code to your advantage could cost you thousands of dollars in any given year, and even tens or hundreds of thousands of dollars over your lifetime. Even if you have a CPA or a tax professional that files your taxes, they're looking at what already happened last year in most cases. So in today's video, I wanted to share a few ways where capital gains taxes specifically do not apply. So there's 6 different situations that we'll cover where you would not pay any capital gains taxes if you follow the rules properly in the IRS code. And just a reminder, everything in this video is educational. It should not be taken as tax, legal, or investment advice. So first and foremost, capital gains taxes come in 2 flavors. Short-term, which is when you hold an asset for less than 1 year, and long-term capital gains, which is when you hold an asset for more than 1 year. Short-term capital gains are taxed at the same rate as ordinary income, which is essentially the highest rate that you'll pay on any sort of income. So it depends on your total income for the year, but your marginal tax bracket is the rate that you'll pay on short-term capital gains. Long-term capital gains have more favorable rates. It can be 0%, 15%, or 20% depending on your adjusted gross income. So that's the IRS's way of incentivizing long-term investing as opposed to buying and selling, trading investments and things of that nature. And it's also important to note that capital gains taxes, whether short-term or long-term, only apply on realized capital gains, which means you actually sold the asset. So if you buy a stock for $100 and it increases to $120, as long as you don't sell that stock, you won't pay any taxes on it at all. You might pay taxes on the dividends that it spits out, but you will not pay taxes on that $20 of gain until you sell the stock. Now, again, if you sell it before 1 year has passed, you will pay your marginal income tax rate. If you sell it after 1 year, you'll pay a long-term capital gains rate. Before we dive into the 6 different scenarios where capital gains taxes don't apply at all, in other words, they're 0%, it's important to cover why they are important to understand in the first place. So first, capital gains affect your long-term rate of return. If it's in a taxable brokerage account, an investment account that's not an IRA or a 401k, anything retirement related, you do pay taxes as you go in those types of accounts. So for example, if you have a rate of return that's 10% and you have investments in a taxable brokerage account, but as time goes on, you generally want to rebalance your investments. So any realized capital gains that you have when you rebalance will affect your average rate of return. So let's say your real rate of return is 10%, but after you pay taxes on it, you're really only keeping 8% of that. That's a big difference when it comes to long-term investing and could have a significant impact on your balances after 20, 30 years. So it's important to understand that. We'll cover tax advantage accounts later, but the other reason that it's important to understand capital gains taxes is that they increase your adjusted gross income, or AGI. Your AGI is used to determine a lot of different things like eligibility for contributing to a Roth IRA, Social Security taxation, Medicare surcharges, things like that. So realizing a certain amount of capital gains in a given year could affect your eligibility for all of those things. So it's important to know that ahead of time to avoid that if possible. And just a client example of that we actually came across recently was we have a client that's earning about $90,000 per year, and she's contributing directly to a Roth IRA since she's well under the income restrictions that apply to Roth IRAs, which are the phase out is $146,000 to $161,000 this year if you're single. So again, earning $90,000, she was well under that. She could contribute straight to a Roth IRA. However, she's selling an investment property which is going to have a significant gain on it. She didn't live in the property, so she doesn't get any exclusions. So she is going to have an extra $200,000 of income and capital gains this year. So that's going to push her well over the Roth IRA phase out. So we actually had her stop her Roth IRA contributions because she would have been penalized for continuing those if she kept on doing it. So again, just an example of how important it is to plan ahead and understand these rules in the tax code. Capital gains taxes are also important to understand because they allow you to control your taxable income, especially in retirement. You can choose whether you pull from a taxable brokerage account, an IRA, or other income sources. So being able to pick and choose where your income comes from can allow you to pay less in taxes overall in some cases. So unlike when you're working, your income is coming from a paycheck, you really don't control where your income comes from. So in retirement, again, it's important to understand this so you can control kind of your tax bracket in certain situations. So the first way that you can pay 0% in capital gains taxes is by keeping your adjusted gross income within the 0% long-term capital gains tax bracket. And I'll put those numbers on the screen now. So if you're married, essentially in 2024, you can have an adjusted gross income of $94,050 and pay 0 capital gains taxes on any long-term investments. So that's a huge amount of income that you can have without paying taxes in retirement. If you're still working, obviously you're going to have that ordinary income that's going to probably push you into a higher bracket sooner than not. But again, keeping your income within that certain level where you can allow you to pay 0% in capital gains taxes. And also remember that adjusted gross income is before deductions. So in that example, if you're married, you earn $94,050 in long-term capital gains. If you include the standard deduction on top of that, you can really actually earn over $123,000 in capital gains before paying $1 of taxes. So because the standard deduction, again, applies on top of that, you can really get over $100,000 in tax-free income in retirement, or if you have no other source of income at that time. And we'll show a quick example of this using our tax reporting software, where we can kind of go over a mock tax return just to show you exactly what the numbers look like for those long-term capital gains, including the standard deduction. And by the way, if you've learned anything so far or you're finding this helpful, do me a favor and like and subscribe to the channel here just to help it reach more people. And as always, let me know if you have any questions in the comments. Okay, so here we have a quick example of a couple sample clients here. Again, these are made up numbers. These are made up clients, but we're going to kind of show you a mock tax return so you can see just how much they can earn in long-term capital gains with the standard deduction, as well as that 0% tax bracket for long-term capital gains. So again, hypothetical here, we'll assume that they're retired, so no more wages. We'll leave out Social Security for the time being, again, just to keep it simple here. But so with the $94,050 that they can earn in the long-term capital gains bracket at 0%, in addition to the $29,200 standard deduction for married filing jointly, they can have a total of $123,250 in long-term capital gains and pay 0% in taxes. So we will run a tax report for them real quick just to show you some more numbers here. So as you can see, this tax report shows their total income, deduction, again, the taxable income, which would normally be taxed, but it's in that long-term capital gains bucket. So as you can see, again, $0 in taxes here. They would pay 10% on their next dollar earned, since they would be in that 10% tax bracket after that standard deduction. But again, good way to just kind of show clients ahead of time what they can expect to pay in taxes. So we always like to run through this for different scenarios for clients that are retired or thinking of retiring and starting to draw their income from various buckets here. So again, just wanted to show that real example, and let me know if you have any questions on this in the comments. The second situation where you pay 0% in capital gains taxes is by selling your primary residence. It's known as a Section 121 exclusion. And the Section 121 exclusion basically says that if you sell your primary residence after owning it and living in it for at least 2 of the last 5 years, then you won't pay capital gains taxes on up to $250,000 if you're single, or $500,000 if you're married. So you get to exclude that from the capital gain of selling your home. So for example, if you buy a home and you're single, $400,000 is what you paid for it, and you later sell it for $600,000. Since that $200,000 of gain is within the $250,000 cap that you're allowed, you wouldn't pay any capital gains tax on that primary residence sale at all. This is one that most people are familiar with, but a couple minor details that people may not know is that you have to have lived in it 2 out of the last 5 years. So even if you bought the home 5 years ago, but you lived in it 2 years initially, you moved out into another property and rented it out for 3 years, you can still sell it as long as it's, again, 2 of the last 5 years you owned it and lived in it. And the second detail with a Section 121 exclusion is what's called capital improvements. So capital improvements to your property, like renovations, can increase your cost basis on the property, allowing you to potentially exclude more of the gain than you might have thought initially. So back to that other example, if you purchased the home for $400,000 and you did $50,000 of renovations and you later sold it for $700,000, your basis is now $450,000, so you can exclude all $250,000 of that gain. If you don't keep good records of the renovations, then you may not be able to add it to your cost basis. So you definitely need to prove that to the IRS in the event of an audit. But again, if you initially bought it for $400,000, you might be thinking that you'd have to pay $50,000 of capital gains taxes. But because you made capital improvements to the property, increase the value of it, you get to add that to your basis, since that's essentially money that you already paid taxes on, the money that you used to renovate the house. So that's the IRS's way of saying you're not going to pay taxes on it twice. The third scenario where capital gains taxes don't apply is simply to invest in tax advantaged accounts. This one might be obvious to some, but things like 401ks, IRAs, 403bs, TSPs, 457s, any retirement account does not have capital gains on the investments while they're in the account. The only taxes that apply to these accounts are ordinary income taxes, either before the money goes in, i.e. a Roth IRA, or when the money comes out, like a traditional 401k or 457. So while the money's inside the account, again, you can rebalance your investments as much as you want to. If you have a stock that has gone up in value $100,000, you can sell it and you won't pay a dime in capital gains taxes. So the reason that these accounts are called tax advantage is because it allows your money to continue compounding long term, rather than getting a haircut along the way and paying taxes little by little each year like you would in a brokerage account. So important to utilize these accounts first when saving for long-term retirement goals or any other long-term goals, because again, you keep more of your money in your pocket as you go. The fourth situation where capital gains taxes don't apply, or you can pay 0% at the time of the transaction, is called a 1031 exchange. And that's basically when you exchange one property for another. It can be a rental property. It applies to things like annuities as well sometimes. So normally if you were to sell an investment property, again, that you did not live in 2 out of the last 5 years, that was not considered your primary residence, you would pay capital gains taxes either at short-term or long-term rates. But if you do a 1031 exchange, where you basically identify another property within 45 days that you want to purchase right after selling that initial property, you can basically transfer your basis to the new property and not pay capital gains taxes at the time of that transaction. Now, admittedly, this is more of kicking the can down the road with the capital gains taxes, because eventually, if you do sell that property prior to you passing away, you will pay capital gains taxes on it eventually. But normally, at the time of a sale of an investment property, you would be paying taxes, whereas if you exchange, you don't have to pay any taxes at that time. And the fifth scenario where capital gains taxes would not apply at all is what's called a step up in basis. I will start by saying that this step up does not apply to tax advantage accounts and certain types of trusts. But if we look at a regular taxable brokerage account, a step up in basis means after the original owner of that investment dies, whoever inherits the asset gets a cost basis that's equal to the market value of the asset as of the time of their death. So, for example, let's say your beloved grandmother owned a stock that she bought at $10,000 decades ago. Stock has now grown to $500,000, so obviously quite a significant gain. $490,000 would certainly have a big tax bill associated with it, even if it was long-term. But if she decides that she doesn't want to sell that stock, she wants to gift it to you when she passes, when you inherit that stock into your own account, your cost basis would jump from $10,000 up to $500,000 immediately. So you can actually sell that stock as long as it's still worth $500,000 at the time of the sale, and you would pay absolutely no capital gains taxes. If it increases to, say, $550,000, you'd pay capital gains on that gain, but not anything else. And slightly related to this topic is donating stock that's highly appreciated as well. So you can avoid paying capital gains taxes if you're charitably inclined and you wanted to donate some of that stock that we talked about in that example. You could donate it at its current market value, receive a deduction potentially as of the current market value, rather than having to sell that stock first and then transfer cash to a charity. So again, in that example, if you donated the $500,000 worth of stock, or your grandmother did, I should say, she could receive a deduction of $500,000, subject to certain limits based on income. But rather than selling that stock and paying capital gains taxes on the $490,000, she can just donate the stock directly to a charity or a donor advised fund and avoid paying those taxes as well. And lastly, the sixth way that you can avoid capital gains taxes or pay 0% is by tax loss harvesting. Capital gains are what's taxed. Losses are not taxed at all. In fact, they do offset any gains that are experienced in the same year. So short-term gains and losses are netted against each other first, and then long-term gains and losses are netted against each other, and then finally the short and long-term is netted against each other. So for example, if you have a stock that you purchased at $10,000, it's now worth $20,000. If you sell that, you have a $10,000 capital gain. But if you also have another position with a $10,000 capital loss, they will offset each other and you won't pay any taxes on the gain. So the good thing about capital losses as well is that if you have losses that exceed your gains, so let's say you lost more money than you gained in a given year on your investments, you get to carry that forward indefinitely to future years, and you can offset that against your ordinary income. So up to $3,000 of capital losses can be used to reduce your income for the year, which can be useful if you are in a high tax bracket and you want to carry that forward to future years. So just to sum everything up, capital gains taxes, they can be a blessing or a curse depending on how you work around them. So again, we always like to look forward into the future to plan these things out, make sure we understand everything before making financial decisions. As I said at the beginning of the video, make sure you work with a tax professional for advice on your personal situation. This content is only educational. So I hope that was helpful. Let me know if you have any questions in the comments, and be sure to like and subscribe for more.